name's Robin Dunbar from Grid Metals, based in Toronto. Our company is a critical metals developer in the province of Manitoba, central Canada, and we're focused on lithium and copper nickel development there.
In that order?
Well, we're working on both. We're walking and chewing gum at the same time. So
wow. Okay.
I know that's not always
we better get into
the rigor in the industry to do two things, but yes.
No, but here's the thing. You know, you work nickel copper. When we originally started speaking, you saw an opportunity in lithium when the lithium market went crazy, and it's come off. Are you regretting that decision?
You know, actually, no, because we have a really unique value proposition for our lithium project, and you know, we think it's going to stand the test of time. And you know, what we're doing now is advancing that without spending a lot of money, but very value added work on the project.
What's that mean? That sounds a bit cliche, like value added. What's actually convert to in reality?
What we're actually doing is we are trying to get the project permitted. So and that's you know, going through the provincial permitting process, and we hope to have a permit for the project sometime next year, maybe even in the first half next year. And we think that'll add huge value to the project, because when the lithium price recovers, we'll be able to take advantage of that.
Okay, we'll come to when it recovers in a second. But when you say permitted for what? What will you be able to do once permitted?
Yeah, so
mining.
You know,
okay.
a mining permit. Yeah, so the value proposition for our project, lithium project, which is Donner Lithium, is we are looking to use somebody else's processing facilities to process. We would mine, but not have to build a concentrator and tailings, which take 3 to 5 years to permit. We would just get the mine permitted, so that the timeline for permitting just your mine is much shorter, and then we would truck the ore to an existing facility and process it there. So cutting out years of permitting and hundreds of $1 million of capital cost. That's right, what's unique about our project.
Right. This True North mill we're talking about?
We have a lease on the True North mill. We also have an MOU with the Tanco mill, which is a producing circuit, and they're both in different directions. So, you know, we have not made a final decision on where we would go. We still have more work to do on discussions at Tanco before that becomes a viable opportunity. But we have the lease on True North. We've done a study on True North, and we know that would cost more for capex, but be a valuable processing option.
Right, and so and when will you make that kind of trade-off decision? Is it more a case of we'll get the permit in place, understand our economics better, and then we'll work out what we can do?
Yeah, I mean, we do need higher lithium prices. So, you know, when we see the price of lithium, you know, getting to the point where it makes sense to put more resources into it, you know, we would finish our economic studies and make a final determination of what makes sense, right? So we're also looking at, you know, expanding resources. So, I mean, you know, to get scale to the project, ultimately use both facilities. So that might be possible too. So, you know, we're keeping our options open, and but the key is getting the mining permit. So then we've got ore that we can take somewhere. So that's key.
Yeah, absolutely. Because I think with them from Tanco, from memory, you talked about there was an agreement signed in 2022 for testing and bulk sampling, and even tolling eventually. So why have they not come up where you and not agreed some provisional numbers subject to? What's holding that?
Yeah, so you know, last year we got when the True North mill became available, that option, the economics appeared to be better for True North, because, you know, with Tanco we were talking about a 50-50 profit split. With True North,
of what?
So we pay for the mining cost, they pay for the processing cost, and then we sell the concentrate that comes out of the plant, and you know, revenues, you know, less expenses. We would that would split that. True North, the agreement that we worked out in the lease agreement is there's a payment per ton, there's a royalty. We would get a bigger share of the margin. But with True North, there's the reconfiguration cost, which we announced that later at the end of last year. It's going to be about 50 million. So still relatively small and very small in the the realm of what these plants cost, but significant cost. So we have been working on the assumption that we're going to go ahead with True North, but if the option came for Tango, for example, if we expanded some of our resources, and we could send some to Tango as well. So we have to finalize that agreement. We're still in discussions. See how that goes. True North is in the bag. We know we have that agreement in place, and Tango, we're still discussing with them.
Okay, so I guess what I'm trying to get at here is there a plan, right? It's like you kind of segued into lithium. Felt like a good idea at the time. Prices have come off. And you've got to have a view on going up to 80,000, down to 20,000, down to 12,000, and I don't know where it's at today. Is it 15, something like that?
Yeah, still low.
Where are we at? But yeah, it's like it's got to levelize somewhere. I think most lithium companies I talk to would want it to be sort of around 30,000. That sort of level, 30, 35,000, but it's going to take time for the market to react. I mean, when you're looking at the lithium market now, I mean, what are you seeing? What are those conversations that you're party to, which keep lend you to believe that the price will recover?
Yeah. So the 25% project holder of ours is Warta, which was the group behind Lithium Royalty Corp. And they keep in very close touch with the market around. Their view, I think, fair to say, is that they see the prices have more or less bottomed, and over the second half of this year we'll see improvement in the price. So that I think is a more educated view than mine. I think it makes sense. Clearly, there was a lot of sources of supply that came into the market from marginal sources when the price was that high. We can't control that. So what we're trying to control is our capital allocation and how we allocate resources to our lithium projects. So that is primarily right now, as I said, on the permitting that because that there's an opportunity in the Manitoba jurisdiction to advance these projects. The government's positive. The First Nation we're working with is very positive and constructive on mineral projects in their area. So we want to take advantage of that, get the project permitted, and then that's a real asset, having a mining permit. Just like some of these projects, people don't realize how many years they're going to take, and they can be very complex. You're dealing in Canada with First Nations issues, with provincial governments, federal governments, local issues. They can take. You talk to some people, they take 10 years to be permitted, right? I mean, people don't realize that when they're making, oh, look at this resource, it's a big resource, it must be great. It's so there's two ways to get value. You can have a very attractive resource that a bigger company is going to buy, or you can get it in production. So there's only going to be so many projects that are going to be bought by deep-pocketed investors able to spend hundreds and hundreds of millions of dollars on these things, or you're going to get in production yourself. And I think as an investor, you have to look realistically, how quickly can these projects get put in? What's the time frame, right? And when you go into that development cycle, that's, you look at the Lassonde curve. When you've announced you're developing a mine, people typically don't like that because, it's capital intensive. It takes time. It always gets delayed, right? So for us, we're trying to really shorten that down, get it permitted at a time when the market's weak. And when you start to see some press clippings, oh, the price of lithium's coming up, somebody's going to write a story. Who are they going to be the new juniors into production in North America? Well, we want Grid Metals to be at the top of that conversation because, if we're not permitted, we're well down the road, and we're on track to be to make money and grow the business from that.
Right? Okay, growth should be part of every conversation from every CEO. But I think if I look back at what happened in the lithium market, I'd say November 2022, $80,000, right? Everyone and his mother decided to get into lithium. A lot of new lithium companies created from new or people like yourselves who may be looking at another metal, went to lithium, new metal lithium. that's in a high price environment. In a low price environment, the wheat from the chaff gets sorted out. You either got it or you haven't. I think what I'm hearing from you is the fact that if you can get this permit, and if you can get agreement, well, you obviously got the option on True North, but if you can get the agreement with Tanco as well, you've got optionality in terms of getting the lithium out of the ground and processed and splitting whatever the economics of that look like. You'll tell us, but so I need to believe that.
Mm-hmm.
What I also need to believe is that you've got a good project. So can remind me, what do you have today?
Yeah, our resource is a 7 million ton resource, so it's relatively small in the scheme, but it's a quality resource. So it is a vertical dike. There's two of them. They're extremely consistent. Mineralogically, they're extremely consistent. We've done lots of met tests. They make a nice concentrate. The recoveries are around 70%. So and there's a portion that can be open pitted. So that's the basis. So it'll be very consistent to mine. And when and if we have to go underground mining, it's white rock surrounded. The country rock is black rock. It's vertical. That's the cheapest, underground mining scenario. So, it makes up for quality what it lacks in quantity. And frankly, if this was sitting out in the middle of nowhere and we had to build, our own concentrator for $250, $300, $400 million, it would have to be an order of magnitude bigger. We wouldn't, I wouldn't be spending time pushing this, project. But we are 35 kilometers from a mine that's been producing lithium, off and on for, almost 50 years. And there's an area here that, it's a critical metals hub. So lithium is being produced and base metals are being produced in Manitoba as well. So we originally got this project, the lithium dikes, because we had got the base metal rights. And when we saw what was happening with lithium, we just felt that, lithium had a lot of advantages, and that, we felt these, we could drill off a resource quickly which is what we did. We did it, in a record time. And that, we thought that, there's a good chance for a toll milling agreement somewhere. So meaning you don't have to put in infrastructure, and that, there's lithium, you have, your tails are non-acid generating. So environmentally, it's much easier. So we just thought it was a tremendous opportunity with the high prices. And, maybe we got distracted, we were enticed by the, the margins. I mean, at the high prices, these things would be phenomenally successful. But when the prices revert to a long-term price that will incentivize, new projects in North America, we will be able to make, significant money, on this project if the economics turn out, what we think. And again, we think it's going to be, $800-900 per ton of spodumene concentrate. And, we think we can make 100% money. Say we can make if it's 2,000, we can make $1,000, US per ton, and would do 75,000 tons. That's $75 million per annum for a very simple mining operation, starting off open pit, underground, send it to in the case of Tanco, they have, a workforce there that, they have a smaller existing mill. They want to build a bigger one. But it's an area that there's expertise, and we're close there. And True North will be more complicated, but that's a facility. There's a road that goes directly there too, and we think that's a viable option as well. So, having two options is we think is better than one. We don't know exactly how it's going to turn out, but again, we want to keep the optionality and get our permits so that we're ready to go when the prices come back.
Well, yeah, it's better than spending $200 million building your own one. But you mentioned $75 million under certain conditions, right? 75 million,
but that's
75,000 tons.
The ballpark, yeah.
Right. Okay. And the economics of that to be discussed, and how that's split to be discussed. But it's changed my mindset. Like, when you first started talking about it, I was saying, well, this is just a kind of feels like a bit mom and pop and small. But when you start throwing numbers in like that, with margins in like that, and there's lots of ifs, buts, and whats in there around pricing assumption, but assuming it moves that way today, starting off small, it probably not necessarily what the market wants to see. It's not going to be encouraged or enticed by a small operation hoping for a price increase further down the line. Is there any blue sky? Is there any upside to this business model of yours?
Sure. We have 7 million tons. We can definitely grow that to depth. We think there's other opportunities in our area to find other deposits. We've identified spodumene dikes on our own property. There's some other deposits in the area. If we have dibs on the processing, we have the opportunity to go and acquire new deposits, double the production. Say we can get to 150,000 tons per annum. That's starting to be the scale that can support a chemical plant. And it's not one of the larger projects, but it's a significant project. And the beauty of it is, again, assuming something like Tanco would be extremely low capex or none, there would be site costs for starting the mining and underground mining, and then capex for true north. Still, the total capex for that scale of operation is very, very, very low. So that's the attractive. I mean, the other side of mom and pop is that you can take advantage of good prices by not having to lay out significant capital. And if I'm a banker, I'm looking at these projects and going, oh, the price is back high. Well, how long is that going to last? How long do I have to wait to convince my credit committee that the price is going to stay here to repay my loan, right? So if I don't have to lay out that capital, I can make money for those 2 years, and now I've got money in the bank, and I can self-finance, acquire other things. I mean, so it's a in a way that those are the cards that were dealt to us. So we're taking advantage of what we have, managing what we have. Yes, we'd like to find, a big giant new pegmatite, and we may. It's a highly prospective area. The Tanco pegmatite, which is in the same greenstone belt, is a world-class pegmatite. And, they've been mining that for, since 1968, it's being mined. So there are big ones out there, not particularly easy to find, but there's lots of pegmatites in the area, and there's much more. I'm convinced there's much more to be found, and a lot on our ground. So I think we're just getting started here, and we're looking, how do we grow this business, and one step at a time, right? That's what we're thinking.
Okay. You got to be in the game to play the game, right? So I think there's a lot of that.
Yeah.
Okay, so that's where we are with lithium. So the potentials there, optionalities there. So permit, have you got a timeline on that, or have you got a timeline on any of the kind of these moments that you think are important this year on the lithium?
Yeah. So the first permit that we applied for is the advanced exploration permit, and what I can say on that is, we're very close on that, and we've got very positive feedback from everybody. There's some things that we have to do to get that, but that permit will enable us to put in a bridge, a road, clear the trees, put up buildings on site, and take a bulk sample. And so that's a huge permit. So we're very close on that. The next is the full mining permit. We've started that process, and we would like to have that certainly next year, and ideally in the first half of next year would be to get a mining permit. So we're still, there's things we're doing to get that together, but that's our broad brush timeline here, and we're actively pursuing that. That is on full court press. It's actually not that expensive, because we've done so much of the baseline work and long lead time that was done in the past for our base metal work, and it's in the same footprint. So we're well down the road on the permitting. So it's an aggressive timeline, but that's what our consultants are telling us.
Okay. Let's talk about copper and nickel, two metals back in favor. I mean, nickel back over $20,000. Copper hit over $5 a week ago, back down at respectable 480. Are you, well, what's happening there? What are you doing with that project?
Yeah. So what we did in the last, year, last year we went out and, acquired a big portion of the greenstone belt that we didn't have. So if you look at a map on our website, you'll see the Bird River Greenstone. It's like the Ring of Fire. It's a big horseshoe, and there's the north arm and the south arm, and we didn't have the western part of the south arm, and we went out and acquired that. And there was a deposit on the north arm that we acquired. So we did 2 transactions, and in historical resources we picked up, and resources that were done in 2009, about 7 million tons. Some of the material in that quite high grade. And we just announced a resource May 6th on our own ground, an up-to-date 43101 resource, incorporating all the drilling and updated everything. And that was 47 million tons. So, in ballpark figures, we have 47, we have another 7 million of historical resources. It's roughly, it's over $4 billion of metal. And most of the metal is in what we call pit constrained. So if you design, the consultants do a open pit resource, that means if you roughly, broadly speaking, you could take that in an open pit. So that is where we are now. And what we think we want to do with this project is take that from 47 million tons. We think if you could get to 80 to 100 million tons, you've got a project that's got the scale to be meaningful. And that would produce copper concentrate with some precious metal credits, and a nickel concentrate with precious metal credits and cobalt. And those would be sent to, smelters. The characterization of this is that it's moderate grade open pit. It starts to look really good when the copper price goes up, which is, part of the story. But there's also exploration potential. There's been very little exploration for high-grade massive sulfides, and we've seen some of that in our drilling. We have high-grade nickel in our drilling. There's actually part of the resource on the nickel deposit is close to 1% nickel equivalent. It's over 5 million tons. So these type of deposits are, we've got the potential for the bulk tonnage, but also through exploration, finding these really high-grade deposits, which, the international mining community will pay, millions and millions of dollars for. And that's, we have leading our exploration, Dave Peck. Dave ran global nickel exploration for Anglo American. He knows, he's an expert on nickel exploration and how to find them, what you're looking for. And so, we see a real opportunity for this project to progress. And the next step is go out and start drilling some of our, best targets, and, show people that, this project has got significant amount of resource, but also, big upside. And then all the intangibles, like, the Inflation Reduction Act, the car companies want to buy, nickel, cobalt, copper, lithium too, in North America to feed the plants, because then they get the tax credits for the consumers. So there's very, very few projects like this around. Most of the we call them more higher grade deposits are too small. There's nickel projects in particular, which are, giant that are, low grade, will require billions of dollars. Those are kind of in their own category. So we're kind of in this middle category of company that conventional processing, decent grade, good infrastructure and access. There's not many in that peer group. And so, now the hunt is heating up in North America, and the market's going to see that just how hard these things are to find. And, if you look at compared to other companies, we got a lot of metal in the ground, and we're going to get more. So it's a very good project. It benchmarks well. We haven't been focused on it, so we got to bring it back to the market's attention. But again, it is on the same footprint as the lithium. So when we do exploration, permitting, improvements to infrastructure, talk to the government, we only have one First Nation. It's all, we're covering 2 projects with one conversation in some respects. And so that's why we talk about, a critical metals hub, some optionality to, copper nickel. And even, copper nickel it's a polymetallic deposit. You got, copper, which is ascendant right now, But nickel is I always say it's a heck of a byproduct. It's very strategic, you know, metal. I think its day is going to come sooner than people think. And then payable credits in PGMs and cobalt. So, we're really excited about the project. It's got a lot of legs, and that's going to be the next real catalyst for us, is getting out and doing some drilling on that project.
When do you intend to do that? Because I know you talked about $2.5 million of cash
exploration.
Exploration on the ground. So
late summer and early fall. Yeah.
And how are you dividing that capital up between the projects?
I think we're still in the. I would say a significant portion is going to go for the base metal exploration. There's some things we need to do for drilling for lithium, but would I be excited about an increase in the resource from 7 to 10 million tons, or upgrading the category from an inferred to indicated in this market? Probably not. And if it's something you don't need to do today, would I be excited by a high grade hit of copper or nickel in a new area? Sure, I would be, and I think the market would be too. So we want to direct our capital, responsibly. But one of the main things is this going to be a catalyst for a stock? And we've lacked catalysts because we have been focused on our lithium, and that's been in a tailspin since last fall. So
I think I hear in the copper the nickel, but I think most people looking in at the news releases you put out in the marketing material, it kind of feels all low grade. Whereas certainly with the project, you're talking about 0.31 of copper. It doesn't feel good. 0.25 of nickel doesn't feel that good. There's some PGMs in there somewhere, but what I'd want to hear from you is what's the total value of the contained metal per ton? Is this?
It's going to be around $75 per ton NSR value at current prices, right?
Okay, that's pretty healthy,
and it is, and the strip ratio is low. So those are the averages, right? So, even in the Mayville, there's, I think the average is 0.43 copper and 0.16 nickel, but the nickel comes in zones. It's higher grade, and the nickel is recoverable. Yeah. There's nickel deposits that are 0.2. It's all silicate. You can't recover it. This is a gabbro, and we did a lot of work with XPS, the Glencore lab in Sudbury, and they did a paper on it. They were so pleased with the recoveries of this low grade nickel. So that is a payable credit, but on average, maybe we mine a slightly smaller. So as we go from 30 million tons to 20 million tons, the grade goes up, the strip ratio goes down, and we're going to be adding to the resources. And the nickel grade for the open pit, if that's how we do it, is a good grade. That's high value rock, and that went from up to 14 million tons. I think it was around 8 before. Significant increase. So we've got some good levers there to work with, and we're going to add more, right? So if we're looking for some higher grade lenses to sweeten these things up, but we got a lot of metal to start off with, and we're just starting the first innings of phase 2 here. That work we did, we spent, there's been $25 million spent on that project, and there's a lot more to do. And that's why we're thinking of, maybe bringing in a partner on that if we find the right one, because, there's 2 phases. There's the exploration and the drilling, which can be expensive, but there's also, if you get to a point where you have say we have 100 million ton resource, well, if we've got the right partner in there, the market's going to say these guys have the wherewithal and the capital to develop it, and so. That's something that, we'll see it. We'll see what comes through the door. But, for now, we want to, get out and do some work ourselves, because the best way to bring in a partner or attract the market attention or raise some capital, for which we'll need to do for next year, is to, put some really nice results on the board on top of a good resource. So, we're very confident that resource has a real store of value and can be increased. And frankly, that's what you're looking at. There's very, very few things like that in North America.
Right. I know you've done the network and sort of understand in terms of the copper, the nickel recovery rates, etc. But what are the other things that are going to sort of draw a strategic partner in, or strategic or otherwise, to allow you to do what you need to do. Because it kind of feels like it was the flagship.
Yep.
Got distracted. I'm not saying there's anything wrong with Donna. I think you've explained today why it's actually could be quite healthy for the company, absolutely. But it needs a bit of love and attention, this copper nickel story, especially in a market like this, because when you talk about those two metals without any description, people are already leaning in.
Yep.
And it's how are you going to be able to take a 2014 PEA and give us a sense of the economics? What are the things that you're going to be? What are the things that you want to do to be able to give us a sense of the economic potential of this? Whether or not it's to start small and build big, or try and make this something compelling to a strategic partner who spends money on it.
This what we've always gone on the premise, and that's this from talking to a lot of different people in the industry is, you need to get this to if you've got a scale that's going to attract interest from the mining industry, right? And it ideally
right.
a major, but it could be a mid-tier, and so that's going to be roughly a 5 million ton. I said 5 million ton per annum rate of production. So if you're doing if your NSR value is $75 a ton, that's kind of or $80 a ton, and you're doing 5 million tons, that's $400 million Canadian revenues, and you want to get as close to 100% margin on that as you can. So you're kicking off $200 million a year in EBITDA per year.
I get it, but my question to you is what do you do from here today to get to a point where someone's going to be attracted or can see the potential of you?
Get the drills out on the property,
right? Which is kind of the last 3 years been a really boring non-event, hasn't it?
We haven't done it. We haven't done it. We did it.
No, I don't mean for you. I mean the market. The market has not reacted to drilling at all.
No, that's right.
Right. So how do we change things?
It's an industry, right? So sometimes you do things that are the right thing to do, and maybe the market's not getting excited, but the people in the industry who are looking for these things, I guarantee you, these companies, there's a lot of people looking for nickel, the very strategic metal, a lot of people looking for copper, and they realize how hard it is. So those people will be watching, and they're the ones who can get the checkbooks out, and now their bank accounts are more flush, and their ability to, enter into an acquisition or a joint venture or something. So ideally, you want the market to be of interest. And I mean, I am of the opinion that when we put out good numbers from our drilling, that it'll get the market interest, because what we're doing is it's truly belt scale. Like, we have a ton of targets all through the belt. We have a number of deposits through the belt. There's been no exploration at depth, and the geology it's really, really prospective. And that's the first thing that that's the first thing a major, like, if they want to do an exploration project, they don't want a postage stamp. They want to go, okay, we want to see significant resources. We want to be able to go and put our foot on the whole belt. We want to develop. We want to be able to make it our own hub and be working there for 25 or 30 years. And that's what we have in Manitoba in the Bird River Sill. And that's what we did last year, kind of that deal we announced. Like, we picked up the rest of the belt. Most of the belt we have now. We've got all the known mineralized showings for copper, nickel. And, part of it is, drilling off the extensions, but there's a ton of new stuff to drill. And I think we got a really good shot at getting to the scale we need. And we got a really good, shot at finding, a really high grade deposit. So, I think as you look at the Ring of Fire that, Wyloo bought, so they spent $800 million on that. That's not a huge deposit, but it's a high grade deposit. And that's in a channelith. And, there's been multiple phases of research by the Canadian Geological Survey and the various geological surveys that tried to identify other greenstone belts in Canada that are like the Ring of Fire. And I think, don't ask me to name them, there's 3 or 4, but Bird River is one of them. And if I'm a mining company saying, okay, I want prospective geology, I want to see high-grade nickel mineralization and high-grade copper and PGMs, chromite, there's actually a lot of chromite in the Bird River Sill. And I'm not going to go to the Ring of Fire because there isn't a road there yet. And so I want to go to one of those greenstone belts that has that. Well, guess what? We have that. And you can get in your car in Winnipeg and go to Tim Hortons and get a coffee. And by the time you get out to the property in your car, you drive right out there, you still got some coffee if you get a large, and it's still warm. And that is worth a ton, because your development costs, your operating costs are going to be way lower. Capital costs are going to be way lower. And you still got the same prospective geology, and the belt hasn't been explored. And you've got a company with a $15 million market cap. You know, a great example of this, this Foran Mining. You know, that company really made a shift and focus into developing that project, and they went from a 15-20 million market cap to $400 million. And they did market cap. They did that through exploration, bringing in the right investors, you know, bringing in the right management. And, you know, we think we've got the very analogous situation in Manitoba. And, you know, it's a great model to follow, and it really stems from drilling. And we've got an excellent, you know, geological team led by Dave Peck. And, you know, he's able to bring in the best in geophysics and, you know, all the different aspects of the exploration program. And it really just comes down to money. And thank goodness in this market, we have some money to start the ball rolling. And I think we're going to start the ball rolling, and people in the industry and then the market are going to go, whoa, this is a serious project. And, you know, when we had this project, you know, we were working with an Australian group. We were working, you know, one of the reasons we didn't do more exploration, we were trying to put this in production. 2008, a company called Western Areas. We were working on a feasibility study before the market for nickel crashed. But, you know, we had a $100 million market cap just on the nickel resource. So when the market, you know, wakes up to this, there's a huge potential re-rating for us. But they want to see commitment. And this is where it comes down to, okay, well, you're doing two things. Well, what are you, lithium or you know, nickel? But, you know, at some point we may have to make a determination and, you know, separate the assets. But we don't want to create an orphan and of either commodity. And right now there's so many synergies, and we're not spending a lot of money on the lithium. So now we're going to allocate some resources to the base metals. And, you know, they both have very good attributes as projects. And, you know, we think we can add a lot of value to them. So that's what we're going to do.